Hello and welcome. You're watching KYC. Now, a lot of the companies that we've been speaking to and speaking about are inward looking. And therefore, to some extent, if at all, that's still part of the equation in terms of investment. It's also tariff insulated in that sense. So let's look at PNB Housing today actually. So interesting because we've seen a turnaround in the business of sorts, very strong numbers that we've seen, 2.5% plus on the ROA number. Can that sustain is the first big question that we'll ask. The second one is what's the expected credit cost as it normalizes. This is the provisioning number which hits your profit and loss account. So what that number is going to be as it normalizes. They're going into slightly new businesses as well, newer geographies as well. Does that at all impact your credit cost in terms of expectations? The third piece is with regard to risk within the affordable housing finance segment, and this is something of an additional point to what we just covered. With regard to credit cost. As it normalizes, what's that kind of number that we look for? What's the possible risk to growth? Because growth has been tough in terms of visibility, at least over the last 3, 4, 5 years. Can that change going forward? That seems to be the guidance. What will be the levers and what gives the comfort that growth is back for good? Now, in terms of the fifth point, asset quality has improved substantially. Can this kind of number start to sustain? Is this the realistic number that we look for? And last off, most importantly, from an investor perspective, are valuations at this point looking fair? That's really the question we'll try to delve upon. And in order to start and try and break this down, as always we do, let's look at the metrics that we'll look at when you're looking at a PNB Housing. Before we look at metrics, let's look at the company itself. First, what do you look at? It's the third largest housing financier in the country. It has around a 98.5% within its entire loan book base. It's got around 98.5% of retail loans. So predominantly is doing retail at this point. It's in that process of going into retail and rather has now almost completed that process. Within retail, individuals is roughly 72% and non-housing loans are around 28%. Okay. When we're looking at a further split within the individual mix, look at self-employed, which is 39%. 61% is salaried. So that's a fairly healthy mix on both sides. You may want to have a little bit of more salaried in that segment. In terms of the lending split, around 75,000 odd crore in terms of the loan book value. Prime loans, prime markets are around 55,500 crore. Emerging markets are around 14,125 crore in terms of book size. So around 20% is emerging markets and roughly 8 odd percent is affordable housing. And this book is growing extremely fast. It's grown from 1,000 crore to 5,000 crore in a matter of a year. So watch out for that one. How will that impact margins will be one of the questions that I'd be curious to understand. 356 branches. They had 300 branches at the end of FY24, currently at 356. This is how the branches stack up and the AUM stacks up. Maharashtra is the predominant force in terms of loan share, 22%. Tamil Nadu at around 11.5%, Delhi at around 11.1%, Telangana at around 9.1%. And then, so predominantly the top 5 states, and I'll read them out, Tamil Nadu, Maharashtra, Delhi, Telangana, Karnataka account for 60% of the loan share for a PNB Housing. Something again to keep in mind. How do they sell? How do they go distribute? In-house distribution is around 53% and direct selling agents is around 47%. That's how the distribution mix is playing out. Let's look at the borrowing mix, and this is where it becomes important because it will start to impact your cost of funds. So something to look out for. National Housing Bank, roughly 13%. Term loans is 38%. ECB is around 6%. Deposits is around 28%. Also the largest deposit taking housing financier in the country. NCDs is around 10 odd percent, and then you have certificates which account for roughly 5% odd. So that's how it kind of stacks up in terms of borrowing mix. Let's look at the metrics we'll track today. You have income statement, you have balance sheet, you have operational metrics as we do with all lenders, and we look at asset quality as well on this one. We'll also look at shareholding pattern, valuations, street cred, and street coverage. We look at all of those and try and break it down, and thereafter speak with the management and try and get a perspective as to what can be expected on some of the apprehensions that are there with regard to a PNB housing as well. What are the risks like? But let's start off with an income statement. You know, the net interest income growth has been roughly 16% on a year-on-year basis, CAGR 3-year. That's how the NII growth has been. It's not been very impressive for that top line number. You'd want a better number, but the last 3-year CAGR looks okay. The last 2 years is just 20% absolute. So just about maybe just about single digit in terms of compounded annual return. So something to look out for. But what's really driving the numbers with regard to PNB housing and the profitability number is the provisions number. Provisions have come off sharply. The book has improved quite sharply. Now we're starting to see recovery start to play through. So they are playing an active role with regard to ensuring that recoveries which they have provided for earlier, all the recoveries have started translating on the PNL and are impacting the PNL also. Let's pull up the profit after tax number, and there's a negative 158 crore of provisions. So that's a write back of around 158 crore. The profit after tax is sitting at around 1,936 crore. So not only is it inflated with regard to the 158 crore, which is the net of the provisions made this year versus the recoveries. The recoveries are roughly 360 odd crore for the current financial year. So not only is it that, but the profits have seen a bit of a boost in FY25 on the back of those couple of factors. So profit after tax has gone up 32% over the last 3-year CAGR, but that's also because of this recovery number, something to be kept in mind. So thumbs up with regard to this, because you have decent growth on the top line, provisions which are credit costs which are not translating to the PNL, which is a positive, and then you have profitability which is seeing a surge. May not be fair to look at this profitability standalone, but nonetheless you are expecting FY26 also to continue to see recoveries, and therefore you might see this profit as something which is more normalized in any case. FY27 will be where the real test starts to play out, where the income statement profitability is concerned. So we'll give this a thumbs up for now. On the back of that, let's look at the quarterly numbers as well. Q1, Q2, Q3. The NII number has gone up in a phased manner, fairly decent between Q2 and Q4. Provisions have largely seen write backs in Q1, in Q2, Q3 and Q4, and profit after tax has been quite steady in that sense, with Q4 being the real outperformer, which is why the stock also buzzing in trade. Now let's look at the balance sheet, and this is where it starts to look slightly difficult. Let's look at FY23, FY24, FY25. No significantly sharp growth that we are seeing on a book size which is decent. You know, we have a Bajaj Housing as a comparable which is growing at a far faster clip. We have some of the smaller ones which are maybe a third of the size of a PNB Housing, which are also growing at a faster clip. But PNB Housing in terms of growth has dragged. Can that change? That's what the management seems to be suggesting, but we'll have to wait and watch whether that does. So the AUM growth currently, 3-year CAGR, is just 7% at this point over the last 3 years. So what's happened to capital adequacy as a result? It's gotten better because profitability metrics have gotten better while growth hasn't happened. So you're seeing a decent amount of capital build up within the company, but growth is where the concern seems to be. Let's look at operational metrics now. Let's look at the margin number. It's largely been steady over the last 3 years, which is a key positive, but it's maybe a minor negative from a perspective that your rates have gone up. You would want at some point, as the rates come down, for your margins to likely get better. Can they do that? Is there scope for that? Will be the question. Your ROA number has consistently gone up from 1.6 to 2.6%. led to a certain extent by recoveries that are playing out, but also by better operational performance. For sure, that is evident. Look at cost of borrowing. From 7.5% in FY23, your cost of borrowing is currently at 7.9%. So your cost of borrowing has gone up, but has come off from the FY24 levels. Can it continue to come off, and by how much will be the question. Spreads largely have come off, also likely because there's a lower risk build up there. OPEX to assets has gone up as they push retail and push towards branch expansion. Some of these metrics versus some of their competitors look okay, all below what one would expect in terms of at least OPEX to assets, well in range, and therefore we've given these operational metrics a bit of a thumbs up. We've seen an upward bias to margins in FY25. We've seen an upward bias to ROA as well. Cost of borrowing has been largely steady, and spreads too have been largely steady. So positive when you're looking at FY25, which is the short term. Positive when we're looking at the long term. A clear thumbs up with regard to this. Let's look at asset quality. Now this is where it starts to get fascinating. Your gross NPA ratios have come off from 3.8% to 1.08% in FY25. That's truly impressive. When I'm looking at the sequential numbers as well, Q2 1.5%, Q3 1.19%, Q4 1.1%. That's the gross NPA number. The net NPA number also looking equally good. 0.8% in Q3, 0.69% in Q4. So an improving trend on some of those metrics. Something to look out for always when asset quality is concerned. As it improves, you would start to see more confidence come in for the bank to grow as well, or a financial institution to grow as well. Whether this is the normalized level that one should expect in terms of a number is something that we really need to keep our eye out on, or whether, given that they are going into new spaces, whether we're looking at some amount of adversity which could start to creep through as well, and therefore where would the NPA numbers be, is something that we'll have to look out for as well. Now in terms of, let's look at the shareholding, and this is where it also gets a bit interesting. You have the promoter holding at around 28 odd %. You have General Atlantic, which owns a stake in the company, mind you. You have promoters which currently own 28%, and within that promoter holding, I'm just going to try and spell it out. You have Punjab National Bank, which is the promoter entity which holds PNB Housing. But outside of that, within the FI holding, you have General Atlantic, which holds roughly 7.5%. That's Government of Singapore, my apologies. General Atlantic holds roughly 5 odd % of the company. So again, there's a decent amount of FI interest in this one. Something to look out for again. There's a decent amount of DII interest as well. You have lots of mutual funds which own a stake here. There's an Aditya Birla Sun Life, HSBC Small Cap. You have Nippon, you have HDFC, you have Axis. All of these hold decent chunks within the company, and therefore it's got a decentish participation. But the promoter holding is 28%. They borrow largely on the back of PNB being the key promoter here, and that's why their borrowing cost is low in comparison to some of the other housing financiers. Again, that's something to look out for, because this promoter ownership of 28% likely to stay steady, but any change there could well impact the numbers for PNB Housing. That's how it's playing out. Currently, the public holds around 20.5% stake in PNB Housing. So that's shareholding done. We'll give that a neutral given the risk. Let's look at valuations now. Let's keep three things in mind. One, your asset quality has improved sharply. That's a positive when you're looking at valuations versus some of the others. Point number two, you're looking at growth which has not been coming through, at least over the last 3 years. So on that count, the slower growth merits a lower valuation, and that's what it is, the 1 year forward PE. And three, you want to see a smaller book grow at a faster clip, but with new businesses coming in, there could be increased risk. So those three factors to be looked out for when you're looking at valuation. 1.5 times price to earnings, certainly 1 year forward, looks cheaper than some of the other counterparts within the housing finance space, but those are smaller than a PNB Housing. PNB Housing has a larger base as well. And you also want to look out for how the last 5-year average price to book multiple is, which is at 1.2 times. So in that sense, it's a slight bit of a premium. Again, we'll give this a neutral because there is a turnaround coming, and we have seen leadership talk widely about that turnaround, and we've also seen analysts cover that turnaround a bit. So maybe a few of those aspects need to get balanced. Let's look at street cred. Well, it's performed very well over the course of the last 3 months or so. 30% returns. Last 1 month has been 24%. Last 6 months has been 18%, and last 1 year has been 35%. Truly impressive given the fact that markets haven't done as well in the meantime, especially broader markets. Let's look at street coverage. They have 12 buy ratings, no hold, no sell, and a 14.5% upside on the stock. So a positive with regard to that as well. Let's try and stack it all up and try and give this one our KYC rating. And that's how it stacks up. A balance sheet is a neutral because you want better growth there. Let's look at the next graphic, and within that, we look at how shareholding, street cred, street coverage, and valuations look, and that's how it stacks up. On our KYC ratings, it gets a 6.5 on 8. Very impressive, at least in that sense, but lots of monitorables. And therefore, we bring in Girish Kousgi, who's the Managing Director and CEO at PNB Housing Finance, to speak to us about, of course, Q4 numbers, sir, but more importantly, what the journey of PNB Housing is going to look like in the next 2 to 3 years. Good morning, Girish. It's always good chatting with you. I want to first start off by asking you exactly that. Growth has been muted over the last 3 years. You have guided for a late teens kind of growth for PNB Housing over the next 1, 2, 3 years. 2 questions, therefore. How confident are you, and how does the mix change as a result? Because affordable housing is taking a larger share of the pie when it comes to incremental disbursements.
Good morning, Harsh. I think thanks for the detailed and comprehensive analysis of PNB Housing. I think very impressive. I think let me first address growth.
Yeah.
If you look at PNB Housing, growth on book or disbursements 3 years back, it was flat. It was negative. Now, 2 years back, the growth started off with 10% on book. I'm talking about retail book because corporate we had stopped business because of stress. So it was 10%. FY24, the retail growth was 14.1%, and FY25, the retail growth is 18.2%. We had guided a retail growth of 17%. Against 17, we are at 18.2. So from 10 to 14.1 to 18.2, very clearly there is growth. And if you look at the entire mortgage industry is growing at about 13 to 13.5%. We were below industry average. Now we are far higher than industry average. And this is number one. So very clearly there is growth because we are at 18.2, and not many companies given the mix of prime, emerging and affordable. Even if you have to look at growth within affordable, FY25, our affordable growth is 180%. We took the book from 1790 crores to over 5,000 crores in 1 year. The entire affordable story in 27 months, we have built a book of 5,000 crores. Now the book is 5,070. Look at emerging. We started emerging in FY25 because of better profitability, better margin. That has done well. Now the book of emerging is about 14,000 and odd. So overall book now retail is about 74,800 crores. The plan is to take it to 1 lakh. So very clearly, you will see that the growth is there, which is in higher teens, which is 18%. And come a year or two, the growth could be in excess of 20%.
Okay. So how would the mix evolve, therefore, over the next maybe 2 to 3 years? How balanced would it be in terms of prime, affordable, as well as your mid-tier?
So because of profitability reasons, we started affordable. Today, affordable and emerging, the disbursement mix together is 40%. And we had guided 40% by March. We started off beginning of the year FY25 with 32% mix. We ended up with 40% mix. Today on the portfolio, emerging and affordable, which means higher yield business, is 23%. Come FY27, so March 27, the overall book is going to be 1 lakh crore retail book. Out of 1 lakh crore, affordable is going to be 15,000 crores. March 25 is 5,070. March 26 affordable book is going to be 9,500 crores. And March 27 it's going to be 15,000 crores. March 27 emerging is going to be 25,000 crores. So 40% of the book in FY27 is going to be from emerging and affordable, and the balance 60,000 will be prime. Prime, we are by consciously, by design, the growth rate we have tapered it down because of margin reasons. Now, FY26, we have started one more new vertical called as loan against property, LAP vertical. Now, this also would help us on the margin. Corporate, this year we plan to disburse about 1,500 crores. So the segment shift, we are focusing more on affordable, more on emerging, prime. We're trying to taper it down. The growth will be obviously lower by design, restart of corporate, and a new vertical called lab. All of these things will ensure that growth definitely would be there. I'm sure in next 2 years the growth will be in excess of 20% given the mix. If you take only affordable, our growth is the highest. If you take emerging, our growth is the highest. FY25 emerging growth is 21% on book, and affordable is 183%, and prime is 12%, and this is by design.
Therefore, where should margins lie and where should yields go?
So margin would be stable. Whole of FY25, a NIM was 3.7%.
Correct.
We will be able to maintain that for next 2-3 quarters, and then the margin will start inching up because of the mix change, because of restart of corporate, because of new vertical called LAP, which we started this year.
And any tailwind you will that the margin will get from the repo rate cut?
See, we are very clear on profitability. We are very clear on margins. So whenever there is a rate cut, we pass on the benefit to the customer. Once we saw that benefit coming into our cost of borrowing, so that we are going to pass it on. Apart from that, consciously on 5 things we are trying to increase margin. In prime, we are trying to increase our margin. In emerging, we are trying to increase our margin. In affordable, we are trying to increase our margin. Corporate will be a restart. It will come at a better yield and therefore better margins. And loan against property will come at a better margin. So these things would ensure that we would have enough levers to increase our yield and therefore better margins.
Got your point. And how much therefore would the normalized margin be at?
So FY27, our NIM should be in the range of 4.1 to 4.2 standalone. So today, for example, we are talking about ROA of 2.6, 2.7. So once this write-off pool is exhausted, our credit cost is going to be 25 bips. So FY24, FY27, FY25, FY26, the credit cost would be quite subdued. It will be neutral. It will be negative. So FY26 also credit cost will be negative, therefore aiding for better profitability. Come FY27 stand alone, our NIM is going to be 4.1 to 4.2. Our ROA is going to be 2.5 to 2.6.
Got it. And your credit cost will be sub 0.3 is what you mentioned.
Our credit cost will be 25 bips.
25 bips, yeah.
In FY27, standalone.
Correct. What gives you that confidence? Because you're lending now to corporate, loan against property, affordable housing, where you could see a bit of an inch up. You've not done that in the past. And therefore, what gives you the confidence that you'll be able to maintain that kind of credit cost number?
So even if you look at a credit cost now, it's in that range, 0.2 to 0.22. If you look at FY25, so the way we are building book, we are very, very sure because now affordable book is sizable. It's more than 5,000 crores. emerging book is sizable. So we've seen, our credit cost panning out, which is in the range of about 20 to 22 bips now. So it will inch up and it will be around 25 bips standalone. Even today, if you take credit cost, it's hardly anything. Because of write back, it is negative. Otherwise, it is sub 25 bips. Come FY27, given the mix change more skewed towards affordable, emerging, new vertical lab, so our credit cost is going to be 25 bips.
Yeah, that's exactly what my worry is. You're moving into these segments. My worry is not the 2.6% ROA if you do 25 bips of credit cost. I don't think that is worrying the street at all. Is there a downside risk to that credit cost number? Is the only worry. What gives you that confidence? Again, because you're doing all of these new businesses and hence, some bit of apprehension on this count.
All these are new businesses, to us in some way. For example, loan against property. It is not new business. We are doing loan against property for last over 30 years. It is only a focus by having it, dedicated vertical. So it is not a new business. The only new business is going to be corporate, and there the plan is to take at a portfolio level to about 5 to 6% by FY27. That will be hardly anything. It will be about 5-6,000 crores. There we are very pick and choosy on developers, on the project selection, on the geography and stuff like that. So it's hardly any amount to be really worried about, because rest, whether it is prime, whether it is emerging, whether it is affordable, all the three book, if you see, it is quite substantial, and we have enough experience on that. And the new vertical, it's only new vertical, not a new business. Business is old, 30-year-old. It's a new vertical, just to bring in that extra focus so that the profitability betters.
Got it.
So because of that, we are very, very sure our credit cost is going to be around 25 bips, because this is something what we have seen for last 3 years.
Understood. Point taken, Girish. Thank you so much for this conversation, for being so candid and speaking with us today on KYC, but completely out of time on this edition of KYC. That's all, in fact, the time we have from myself. Everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.